The forms to be uploaded already before we talk on that. So now we have changed the topic and hope it is going to be very much useful for us because there are a lot of updates given every time, and currently this non-corporate entities will have to be very careful in submitting the audit report and things like that. So let us make use of the session. Once again, I welcome the speaker, Mohan sir, on behalf of Madurai branch of SIRC of ICI. It's a pleasure to have you, sir. Thank you very much, please. And I request Secretary CA Venkatesh sir to formally introduce the speaker.
Good evening to one and all. It's a great pleasure for me to introduce our today's speaker, who is going to handle the session on accounting standards and financial statements for non-corporate entities. Sri Mohan R. Lavi qualified as a chartered accountant in the year 1989. He has over 25 years of experience in industry across a variety of industries. He has worked in senior position in finance and in manufacturing and software companies. Mohan sir also has over 6 years of experience in practice. At present, he is a partner with leading chartered accountant firm in Bangalore and head the INDAS and the GST practices of the firm. CA Mohan R. Lavi is the author of books on IFRS, INDAS, key audit matters, and other related topics. CA Mohan R. Lavi sir has spoken at various conferences in India and abroad on accounting standards, IFRS, and the GST, and is a faculty member with the Institute for their IFRS certification course and registered valuer programs. His articles appears frequently in the Hindu Business Line, Deccan Herald, and the Bombay Chartered Accountant Journal. With these few words, I introduce CA Mohan R. Lavi sir before this virtual forum. Now the session is yours, sir. Thank you.
Thank you, Venkatesh sir. Thank you very much. And good evening to all the participants. Let me first thank Mani Megale madam for consistently calling me to attend to do some program for Madurai. One was, of course, as she said, the income tax forms, which we could not do because I could not, I was not able to do the session on that day. So today we are doing this very important topic on accounting standards and financial statements for non-corporate entities. I was also telling her that probably we should start physical courses because, online, there's only so much you can do in online courses. But also I wanted to tell all of you all, which probably was not there in my CV because Venkatesh sir did not have it. I did my articles in a firm called Manian and Rao in Bangalore, which has got a branch in Madurai. So I have come to Madurai in a couple of occasions, and of course Manian sir was a mentor for all of us in the firm. So there's a little bit of a link to what to Madurai also for me, that particular thing. And I know quite a few people at that time. I'm talking, it was 1989, people who had passed out around that time. I knew them quite well also, and some of them are still in touch with me also. So Madurai is not really a new this thing for us. Okay. This session is going to this session is going to be not very technical, I will say, because I will just take you all through the ideas only to talk about the financial statements and accounting standards for non-corporate entities. There are a lot of exemptions given by the ICAI for non-corporate entities. Most of them are disclosure related, and a few standards itself have not been published by non-corporate entities. But before I start, I just wanted to tell you all about why is this session becoming important from the point of view of the auditor. I mean, we will, for a moment, we will keep the client aside, and he is in the non-corporate entities. Most of the time, the auditor in the client does the work of also not only writing, auditing, but also he does other jobs for the client. See, what is happening today is that a lot of information is going out in the public domain. A lot of information about financial statements is going out in the public domain. Analysts are taking out information. The GST department is very, very active in getting information from various sources. So it is important that even a non-corporate entity, though they may not be bound by Ind AS, IFRS and all those accounting standards, it is very critical that certain basic minimum accounting standards and more importantly disclosures are made in the financial statements to the extent possible. I will have to say to the extent possible, because we understand that they may not have huge resources to prepare a detailed financial statements, give too much of disclosures. Probably they may not have all those things, but to the extent possible, they should also look at improving their reporting and disclosure practices. I will look at it. I'll put it that way. As all of you are aware, we have got bodies like NFRA come up now, which has doing a lot of work on scrutinizing financial statements. FRRB of the institute is very, very active. They are also giving a lot of comments on financial statements. So it's important that we look at it from the point of view of giving better reporting and better disclosures. We are not going to talk about AS and Ind AS and all today. So that is because it will not be applicable for most of the things we are talking about today. The non-corporate entity will basically become entities who are not companies, And it could be partnership firms, it could be LLPs also, it could be trusts, it could be non-corporate entities in any other form, right? For them, there are two things which have happened. One is accounting standards. ICAI has given a list of exemptions. A few of that we will be discussing today. More importantly, ICAI has also issued a sort of a guidance note on preparation of financial statements for non-corporate entities. That also a little bit we'll be discussing today. And of course, the entire guidance note is available on the ICAI website. Members can download it and they can look at the financial statements. The idea behind both of these things is to ensure that to the non-corporate entities also, there is some format given. A lot of it is similar to your Schedule 3 of the Companies Act only. But words have changed. Disclosures have not become so detailed. They have done a pretty decent job of trying to ensure that non-corporate entities, to the extent possible, they report all these things as they are required. But even before we get into the non-corporate entity stuff, we will have to look at these standards. All of you are aware of these standards, so I'm not going to we will just look at a few standards which are critical from the point of view of non-corporate entities. We can go up to AS 29, and as all of you all are probably aware, AS 10, AS 15, and also AS 29, and probably AS 28 also on impairment, are almost similar to Ind AS. After the revision, they are almost similar to Ind AS. All these standards have been revised by the ICAI about 4 or 5 years back, and they are, again, there are some differences there, but not too much of it. At least on concept wise, I can tell you all that they are almost equal to what we are talking about from the Ind AS point of view. Also, if you look at these set of accounting standards, you all will notice that not many would be applicable to non-corporate entities. You say, for example, accounting for amalgamations may not be there. They may not have too much of employee benefits also. The main things, construction contracts may not be there because most of the construction contracts entities are in private limited formats at least. Similarly, you will have related party disclosures, but there is an exemption given there. Segment reporting, very little chances of it being there. So even though these standards or the set of standards are there, not all are applicable to the non-corporate entities. There are two things we have to remember here. One is what exemptions have been given by the ICAI, and the second thing is what the standard which is not applicable to the non-corporate entity, you definitely need not follow it also. There are 4 levels, as all the members will definitely be aware. Level 1, level 2, level 3, level 4. This is of course only for the corporate entities. So just this classification also is there. And why I brought this up today was because this level 4 is a new level which has been introduced about 1.5 years back. We only had 3 levels till 1.5 years back. Now we've got level 4. So level 4 has become a sort of a residuary level. So if you do not have a turnover of, or if you have a turnover of less than 10 crores and borrowing of less than 2 crores, or holding and subsidiary companies of these entities, there would be, you would be in level 4. And the level 4, there are more exemptions given by the, for the accounting standards. So level 1, no exemptions. Level 4, greater exemptions. Of course, level 2 and level 3, you only have a few exemptions here and there for, say, for example, disclosure for leases. Those are some of the exemptions that have been given there. So I will look at this from the point of view of only the non-corporate entities, because now that you know these levels, the levels are very important to understand. So I will give you all a small hint, because a lot of questions came up on the MCQs. One of the MCQs is on the levels only. So you can probably look at this slide later on and see, what level is there for this. Not applicable to level 2 and 3 and 4 is cash flow statement segment. There are 7 exemptions given. 4 are cash flow, segment reporting, related party, EPS. Consolidation would not be required in any case. Investments in associates, investment in joint ventures. There would not be a requirement for them to use the standard, because an exemption has been given for level 2, level 3, level 4. Level 4, amalgamation also is not required. Impairment of assets is not required. I will, when I speak about impairment, I'll tell you a little bit about it. For the this is a normal exemption given here. But if you look at the non-corporate entities specifically, you can look at AS3 cash flow. Cash flow statement not required. There is no necessity for you to do the cash flow statement for non-corporate entities at all. Similarly, if you look at AS10, applicable with disclosures exemption. Accounting for PPE will have to do, but a lot of those disclosures, or some of those disclosures, there has been a little bit of a exemption given for. So this is what has been given by the ICAI as an exemption for non-corporate entities. So one question which will definitely come up, because see, each standard disclosure, you can probably do the entire standard itself, you all may feel. Why should I look at this specifically? There is absolutely nothing which prevents you from implementing the standard in total. But I will tell all of you all that the exemptions are only with regard to disclosures. Conceptually, accounting wise, you will not get an exemption from the standard unless the standard itself is exempted cash flow. For example, here if you see cash flow statement, there's no need for you to prepare at all. So there's no need for you to worry about investing, financing and all those cash flows at all. But wherever there are exemptions given, you will have to be very careful that the disclosure exemptions are what you want to avail of. So even though this runs into 3 or 4 slides, for the non-corporate entity which is under your, or you are the auditor of, have a very simple checklist. Is the accounting standard applicable? If the answer is yes, are there going to be any disclosure exemptions? And the third question is, do you want to avail of those disclosure exemptions? My suggestion to everybody has always been that don't take an exemption just because there's an exemption. I will tell you why, for example. For example, in PPE, there is one exemption given. Assets which are held idle, do not disclose it. You have an exemption, need not disclose it. You don't have to disclose it at all. But suppose a large portion of your assets are idle because of COVID, pandemic, and all those things, factory is closed. It may be a substantial event for you to actually disclose it also. So my suggestion to all my auditor friends has always been that first you implement the standard completely. You see how difficult it is about the disclosure requirements. If it is information is available, there is absolutely no harm in disclosing it, because this accounting standards today are moving towards an era of better disclosures. Ind AS, everybody feels is very, very difficult and all. Ind AS is, there are certain conceptual problems in Ind AS. I don't say no, but it's more on disclosure based. It is all, most of it is only additional disclosures. Yes. Of course, if you want to, say for example, AS15. AS15 for a non-corporate entity, according to me, would have a minimal impact, because they may not even have a gratuity valuation scheme. They may not have a, leave encashment scheme. They may not have pension fund. But what you should remember very clearly is that provision for gratuity, if there's an exemption, there's no exemption for a provision for gratuity because that is driven by AS 29, which is your provision standard. So you will have to see at those specific exemptions and only then you can avail of those exemptions. Again, you can see most of it is only disclosure related exemption. But one of the problems I am observing in this set of exemptions given by the ICAI, and which is going to probably be important for all of you all as auditors or as preparers of financial statements of non-corporate entities, is this financial instrument standard. See, there is AS 30, 31 and 32 was never implemented by the ICAI. It was only in draft form. It was completely removed. Now it is not there at all. They have given some exposure draft of AS 109, but we do not know when that is going to come. They're still in exposure draft stage. There can be a small accounting and thereby an auditing issue in case there are financial instruments involved, because we don't have an applicable standard. We only have to look upon AS 13, which is accounting for investments. And AS 13 is not extremely detailed in terms of as compared to 30, 31, 32 and also probably 109 also. Financial instruments, even for a non-corporate entity, would be a very significant standard. Trade receivables, trade payables, cash and bank balances, everything comes under the category of financial instruments. They may not necessarily meet the definition of an investment as per AS 13. So you could have a small situation wherein you may not be able to find an applicable accounting standard for some financial instruments, for which you'll have to go back and look at AS 13 only. And okay, initial recognition at cost. Later on, if you want, you can do a fair valuation, depending upon the financial instrument also. So that is what we will have to be very careful about. You could run into some spots because, see, non-corporate entities which have got major investments or which have got a significant part of their cash flows invested, what will they do? How will they account for it? So this is a little bit of a challenge we may have. One of the things which I think has also been not completely covered in this exemption notification, or for which we require further guidance also from the ICAI, is that, see, if you look at the history of accounting standards, they always say that if you do not find the clarity in this set of accounting standards, please look elsewhere. Look, for example, at AS, or you look at revised AS, or look at Ind AS, or look at IFRS. That is not there in this accounting standard for non-corporate entities. So either one, they will have a small problem, because you say, for example, a deposit given by a non-corporate entity. Let us say it's only a security deposit for whatever it may be, even for a rental or a leasing or any sort of a security deposit to take, for example. It is a financial instrument. It is refundable. We don't have to worry about discounting and all, but it's not exactly an investment. So there, I think a little bit more clarity is required. Right now, what we are doing, we're recording it at cost only. We're not doing any fair valuation because we don't have to apply those particular standards. So when it is not applicable, we don't do it. We are recording it at cost only. But there could be certain instruments wherein you may want to look at the fair value. For example, investment in a mutual fund may require that. Investment in mutual fund, yes, you will probably go under AS 13. But there could be other deposits, other loans given, which may not meet the definition of an investment, for which you'll have a little bit of a challenge. Because of this lack of clarity, my suggestion would be, please record it at cost only. Don't have to worry about because again, valuation, all those things will not be required. You record it at cost only. And there's no need for you to give further disclosures that on what could have happened, provisioning for those assets and all those things will come later on. So right now, this is something which should be very important. Okay, a few of the exemptions. So level 3 and level 4 companies need not disclose carrying amount of temporary idle property, plant and equipment, what has been fully depreciated. The carrying amount, had it been carried on the cost model, that also is a requirement for the revaluation there. The carrying amount of property, plant and equipment retired from active use and not held for disposal. If you look at these disclosure exemptions given in AS 10 revised, it is only for assets which are not in use. Only for assets which are not in use. We should remember that your cost has not changed. Your revaluation method has not changed. Your revaluation reserve requirement has not changed. Depreciation is also not changed. Only exemption given is that you will have to, you need not disclose these particular things. So the relaxation which has been given for non-corporate entities is very limited in that manner. It's very limited in that manner. The concept of cost, the concept of revaluation has not changed. You will find this in a lot of standards as we are moving forward, that conceptually there is absolutely no change. It will all remain the same only, unless there's a complete exemption from the standard itself. But they want to give them the benefit of trying to, give a little bit of lesser disclosures, because they feel that the data requirements or picking up this data for non-corporate entities may not be there. So they are looking at giving these disclosure exemptions here. Now, one of the things we'll have to remember is that, and Marbudi, I think PP is very close to all the auditors' hats. We like PP a lot. One of the things we'll have to remember here very clearly is that I only spoke about depreciation. In my mind, and I've been telling this in a lot of places, especially now post the pandemic, impairment is becoming very critical. The standard on impairment is becoming very critical, because you all would have probably seen it in many of the places also, wherein businesses have not picked up as they had pre-pandemic. Many have not even reopened. Some have shut down. Some have relocated. Some have sold off. A lot of these things have happened courtesy of the pandemic. See, this is a disclosure exemption given by AS 10. But you go back to the standard on impairment. Not much of, there is no exemption for the impairment standard apart from only for level 4 entities. Only for level 4 entities there's an impairment exemption there. If I look at these disclosure exemptions given, it would apply to places where impairment test has necessarily to be carried out. The standard on impairment is mandatory. We will have to follow it. Only level 4 entities have an exemption. To my mind, impairment becomes very critical in case of property, plant and equipment. So just keep this at the back of your mind. And I always tell this in many forums. We all know, of course, though this is not a session on corporate entities, I'll mention this only. We all go by checklist. 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 We give it to the article clerk and say, I start the audit on the basis of Caro checklist. What is the first question in the Caro checklist? They'll say, okay, fixed assets, whether the fixed asset register has been maintained. So they'll show something. They'll say, okay, FIR has been maintained. Has physical verification been done? They'll ask for a physical verification report or complicated document. Okay, physical verification has also been done. See, we are completely depending on what the article clerk is saying. Okay, it's not material, so no need for a negative comment in the audit report in Caro. The third point in Caro actually should be, has the management done an impairment test or not? This question is not there in Caro. And my concern always has been that because this question is not there in Caro, it will never be asked. Because it will never be asked, it will never be answered also. Companies would want to postpone impairment to the extent possible. Of course, when it is inevitable, they'll have to do it. To the extent possible, they'll want to postpone it. And we should remember 28 is a mandatory accounting standard on impairment. We will have to follow that accounting standard. So, it is very important for us to understand that the impairment question comes at least in your accounting standards checklist, if not in your Caro checklist. I've always had this concern that checklist auditing is very, very good, provided your checklist is updated. And now I still remember this Punjab National Bank. I'm talking about 2010, 2011. they had a checklist for the inspection auditors. And the beauty of the checklist is you cannot write anything. Yes or no. You only have to answer yes or no. 85 questions are there. Inspection auditor will go to that particular audit and that particular branch, and he just have to look at the checklist, computer, laptop open, but you have to answer yes or no. So one of the auditors was in the currency chest branch in Chennai, Punjab National Bank. Yes or no? 85 question answer. This question came up. Does the bank have a security guard? So okay, security guard is there. Okay, yes, no problem. Does the security guard change duty every 6 hours or 8 hours? So I think he has gone and seen some logbook and he got that. Okay, fine. New person assigned. So assume that he is changing duty. The third question was very interesting. Does the security guard have a gun? And a currency chest branch, yeah. So the gun was required. So already Pathar auditors, and he said, okay, I think he's got a gun. So he did not want to go and ask him gun irkandana. So he went and saw, okay, gun was there, no problem. So gun also he answered yes. The fourth question was, does the gun have bullets? Because it was a currency chest branch. So the poor auditor, he went all the way to the security guard and said that, I'm an auditor here, I want to know if the gun has got bullets. That guard said, sir, 4 varshama bullet kadaya the gun. It's only for the purpose of scaring of people. 4 years there's been no bullets in the gun at all. But please remember, he cannot make any comment. He only has to say yes or no. So he just came and ticked, does the gun have bullets? He ticked no. And he sent the report to the head office, which was discovered after about 7 or 8 years in the head office. And suddenly they found out that, major crisis there in Chennai currency chest branch. But by the time the branch had closed also. So my concern has always been that if your checklist is not updated, and I'm sure that all of you will agree with me that compliance is becoming very, very difficult today. Compliance is becoming extremely difficult today. In GST, can you put a checklist for GST today? Tomorrow morning it will change. It is impossible. So we have to be a little bit more alert on these exemptions because of the fact that it could have a link to some other accounting standard. So just because an exemption for disclosure is there, please do not do impairment. Impairment is mandatory. That's very important. Foreign currency risk management policy, that is an exemption given for level 3 and level 4 companies. I will only look at what specific exemptions we'll have to worry about. AS 15, this is an important exemption. Non-corporate entities, if you look at LLPs, for example, they may have, let us say, about 50 employees, 50, 60, 70 employees. Here, this exemption is it's actually a twofold sort of an exemption. First one, what they are saying is that if the average number of people who have been employed in the year is 50 or more, they're exempted from non-encashable leave, discounting of amounts that fall due within 12 months, actuarial techniques for defined benefit plans. So level 2 and level 3 companies, non-corporate entities, they have got exemption from 3 very important things. No need for actuarial valuation. No need for discounting, because if you are paying after one year, you may have to discount it. Most importantly also, no need for non-encashable leave. So if you want me to summarize this and tell you all, for non-corporate entities whose average number of persons employed is more than 50, leave encashment provision and also gratuity provision can be made on the basis of estimates. There is no need for you to do an actuarial valuation. Discounting, anyhow, we don't have to do discounting because not more than 1 year. So all these 3 exemptions are given. But if you go back to AS 15 revised, they mandate actuarial valuation. They mandate discounting any amounts payable beyond 1 year. And they mandate it also for non-encashable leave encashment policy. So more they have given an exemption here for non-corporate entities, only level 2 and level 3 non-corporate entities. Level 4, anyhow, it is not there. No problem at all. On what basis can you do the provision? Please go back to AS 29 is what they are trying to say here. Don't, because AS 15 anyhow, go back to AS 29, provisions, contingent liabilities, most reliable estimate. or reliable estimate, we can say. Reliable estimate, if you all do, it's more than sufficient for this. Leases. Again, this standard, especially for non-corporate entities, these exemptions are critical. You look at what exemptions have been given. Of course, I am not going to talk about Ind AS today at all, because Ind AS has completely changed the concept of leasing. They're not at all required. All we know are only two types of leases: operating lease and finance lease. If we have got control over the asset, finance lease, control kadayadana, it's an operating lease. Operating lease, over the lease term, I will amortize the lease rental. Any difference there, I will put it to my lease reserve account. Very simple calculation for leases. And they have got some 5 tests for distinct. Actually, in operating lease is negatively defined. If it is not a finance lease, it becomes an operating lease. So the exemptions, I mean, the tests are like, say, for example, at the end of the lease period, does the asset come to your name or is it transferred to you? Is it given at a very low lease rental? Present value of the asset, the fair value of the asset is almost equal to the present value of the lease payments. It's a finance lease. Otherwise, it's negatively defined as a corporate, as a operating lease here. But here, because the lease would typically be for about 5 or 6 years, average 5 years, you take it as 5 years, you will have a lease term, and they ask us to give a reconciliation, total minimum lease payment, balance sheet at present value. Level 2, level 3, level 4 companies, or all these 3 sets of companies, this disclosure or this is actually a calculation. This calculation requirement is not there at all, not required at all. Because all you have to do for level 2, level 3, level 4 non-corporate entities is that, is it a finance lease? Is it an operating lease? Go by the definition, go by the negative definition of an operating lease. If it is operating lease, expense it. If it is finance lease, show it as a capital, show it as an asset and depreciate it. And whatever lease payable is, lease payment is due to the promoter, to the landlord, you will have to show it as a provision. But all these disclosure requirements are not required. More than 1 year, more than 3 years, up to 3 years. The reconciliation of total payments, all those things are not required for level 2, level 3, and level 4 companies. Because to my mind, this is a very important exemption, because you look at what a non-corporate entity would typically do for a lease. If it is an operating lease, there is no problem at all. Month on month, he'll debit it to the operating lease expense account, no problem at all. But year-end, he does not have to do all these reconciliations. Minimum lease payment, what is the lease period? What is the non-cancelable lease period? How do we reconcile this? All these things will not come. A very important exemption given for level 2, level 3, level 4 companies. Of course, as I have said earlier also, if you are a level 1 company, there is absolutely no exemption from any of the requirements. AS 22 is on deferred taxes. Income tax, of course, there is absolutely no change. Current tax and deferred tax, both, I mean, best estimate. But what they are just giving a very small, what you can say, requirement or relaxation only at the transitional requirement. The first time you become a non-corporate entity, which is level 4 entity, and the opening balance of your deferred tax asset liability would go to your opening reserves. Subsequently, anyhow, you have got an exemption from that. So only that one small thing has been. This is only for level 4 companies, of course. Please don't worry about, I'm giving so much of details about level 1, level 2, level 3, level 4 companies. Anyway, it's there in the slide. You all can see which category your client comes under and choose those necessary exemptions here. But again, let me tell you all that concept of deferred tax has not been given any exemption. Deferred tax calculation would have to be done. Depreciation, 43P payments, all those things. There is no exemption given from the calculation for deferred tax. Only for these level 4 entities, the transitional requirement is there. And then, of course, we'll have to go back to that exemption. Please go back to this slide. Whenever you are in doubt, please go back to this slide and see, is there a specific exemption from the standard? Answer is no here. So only the disclosure requirements or disclosure exemptions we can take here. Another thing which all of you all can probably also think of is that many a time we see that many of these non-corporate entities, they have got plans to grow bigger and convert into a private limited company at some point of time. Many of these people have got these ideas. Better not to avail of exemptions, because always better to continue showing your complete disclosure. Because again, one time you'll show an exemption, then again next time you'll not show an exemption. All those problems would be there. 28 impairment of assets. I've already spoken a little bit about this, but I would again try to tell you all that for level 2 and level 3 there's of course for level 1 entity, there is level 4, there's a complete exemption. There's no problem at all. Level 2 and level 3 also, there are some exemptions given wherein they have said that value in use, basically it means that valuation is not required for level 2 and level 3 companies. Calculation of value in use and the VIU calculation, but if you look at, discounting rate also is not applicable, because you're only going to make an estimate of how much it has been impaired. I think it is best to look at this by way of an example, because in the normal AS28 calculation, I have to use DCF technique. I have no option. DCF technique, and the present value, then we have to find the value, then find out what is the fair value of that particular asset, and then we'll have to look at what is the cost or the book value, carrying amount. If the carrying amount is more than the fair value, then there's an impairment to the extent of the difference. For level 4 companies, complete exemption. Level 2, level 3 companies, they have said that only do an estimate. There is no need for VIU technique, value in use. There's no need for discounting. Because I have told you the standard is very, very important, I will try to explain this by way of an example. I'm assuming, of course, that the entity is not it was a private limited company, but this is also an example of how this level 2, level 3 would actually work. As I have said earlier also, post this 2022, when things started opening up, a lot of these enterprises, as all of you are aware, were shut down for 1.5 years, slowly reopened, some never reopened, as I told you. There was a hotel in Mysore called as Hotel Southern Star. A pretty reasonable hotel in Mysore, very famous actually, not reasonable, pretty famous hotel in Mysore called Hotel Southern Star. The first lockdown, that fellow said that we are going to close down, will not reopen, he said. And he had about, I think, only one branch in Mysore, but he had a lot of, 2-3 restaurants lined to them. It was a proper hotel, right? I think October 2020, if I'm not wrong, he announced that he is not going to continue because pandemic, he lost business. So he said, I'm not going to reopen again at all. And a lot of the employees had left also. Many of these employees had gone to North India, and many did not come back. All these problems were being faced by him. But 31st March 2021, when he had to finalize his accounts, it was not operational for a very long time, as it's obviously from a second wave, and all these problems cropped up there. So when the auditors were finalizing the accounts for 31st March 2021, they had 2 problems there. One is he had already announced that he is going to sell the hotel. He announced that he is not going to continue. He also said, I'm going to sell it. Anybody who's prepared to buy it, please come and take it. Going concern was a topic which was very much discussed there. Because the auditors felt that you have made a statement, so you're not going to be a going concern. They asked me, I also completely agreed and said, yes, it's not going to be a going concern. You don't have a viable business model. You yourself have said it was going to be sold, or you want to sell it, or whatever it may be. Then what happened was that somebody came up and said that, okay, in case you want to sell it, we want to value your hotel and try and find out what value we can get from this particular hotel. Because as I said, a lot of these assets were not in use and all those things. At that point of time, AS28 came into the picture. Because if you looked at the hotel pre-pandemic and post-pandemic, there was a complete change. I'm talking about October 2021 when the accounts are about to be finalized. On the time they said that most of these assets are impaired because your non-operational, non-functioning for more than 1.5 years. Rooms were also not in a good condition. A lot of things had happened there. So there they want to do an impairment test. They wanted to find out what is the value of those assets. At that point of time, I mean, if they had done a normal valuation, DCF technique and all those things, this is the exemption given by AS 28. They are saying, don't worry about all those things. You make an estimate of how much you will get. This is exactly what the owner did also. This is exactly what the hotel people did also. They said, we don't want value and all. I know exactly how much I will get from my assets. So he made a valuation and got out a value of about 7.8 or 9 crores, if I'm not wrong. Total value of assets is 9 crores. That too, after all, calculations he made. No DCF technique, nothing was used. He just used an estimate saying that today, if I sell this hotel, I will get 9 crores. Only for value of assets. Land was anyhow on lease. The person who wanted to buy it said, okay, I'll pay you exactly 9 crores of rupees. Are you okay with it? This person said, I'm happy with it, no problem. So the transaction, of course, I think they fixed at 10 crores ultimately. The transaction was closed at 10 crores of rupees. Why this exemption is important for level 2, level 3 companies is because of the fact that the owner of that enterprise, the person who's running that enterprise, will be the best person to decide or to make a evaluation of how much you will get from that particular asset. In the level 2, level 3 enterprises, non-corporate entities, okay, there is no need for you to do any valuation technique. Of course, one very important thing we should not forget in mind is that whether the asset has completely lost its value, in which case you have to do a complete impairment. That is one thing you have to keep in mind. The second thing also I think we should very clearly remember is that if it is a going concern, I think that there's always a link between impairment and going concern. If only one portion of the assets has been impaired, no problem, going concern is not going to be challenged. But if a lot of the assets have been impaired, then you may want to also check on that going concern. Please remember, members, I'm sure that the branch has done programs on auditing standard. There's a separate auditing standard on going concern. It forms a separate part of your audit report, nothing to do with the accounting standards. If your impairment test is positive and for a large part of your assets, and your going concern also has been tested, and it's not a going concern, please follow that SA 530 or 560 as the case may be, and please report it in your audit report. Adalakuta, there is no exemption for a non-corporate entity. If it is not a going concern, you will have to say it is not a going concern. There is a great link, or there is a detailed link between this impairment testing and the going concern concept. So for these people, it is very important that you can make an estimate. I'll now come to a few specific what I would probably say, advice, I will say. I will not say technical thing, but advice about presentation of financial statements and, generally how to do better financial reporting. Disclosure of accounting policies is something which all the members who are attending today would probably be familiar with. Normally, what do? We take the last year's accounting policy, copy and paste it. There's absolutely no doubt. We all do it. Even I have done it. All of us do it year on year for that particular enterprise, because there is no new accounting standard which has been issued during the year. So why should I, even worry about doing changes and all those things? Perfectly acceptable, nothing wrong in that. We all have done it. In fact, many of the companies follow India's companies, they copy and paste from Infosys and all those things. All that is fine. I'm having no issues as far as that is concerned, because it's a perfectly acceptable technique as long as you are disclosing what are the accounting policies which are applicable to your enterprise, to the entity. That's all is very important. But here, I have felt that there is definitely a chance, there is definitely a possibility, and there's definitely a requirement to report better. The accounting policy, I'm not talking about disclosure, accounting policy also. Right from our CA days, we have heard that revenue recognition and accounting policy, transfer of significant risk and rewards. This is what we say. AS 9 said it, Ind AS 18 said it. Now, of course, Ind AS 115 does not say it, but you look at any accounting policy, they will say that revenue is recognized when significant risk and reward are transferred. Why are we saying this? Because the standard is saying it. But if you want to be a little bit more, or you want to give better information, or you want to report this transaction better, or you want to give better information about what is the revenue recognition policy. You will probably say that in the case of FOB contracts, revenue is recognized when this is done. In the case of CAF contracts, this is what is happening. Or if it's one non-obstant contract, you will probably say, okay, revenue is recognized on delivery to the customer or shipment to the customer. Just saying transfer of significant risk and reward is not going to assist anybody. The user of the financial statement, whoever that person is, it could be a banker, it could be investor, it could be an analyst, it could be a chartered accountant, it could be FRRB, it could be NFRA. Any of those people would probably want that much more information about what is your revenue recognition policy. All I'm saying is give one more sentence. That is all. I'm not talking about giving full revenue recognition policy for all different types of goods and services. Just saying, add one more. What is that event, or what is that event on which, as per which revenue has been recognized? Just add one sentence. There's absolutely no harm. Nobody is going to take any offense from this particular thing. And I can also tell you all, because I'm quite sure that many of these members here are also doing a lot of GST practice. It will also help you all in GST. Because today, as all of you all know, what is the GST department doing? They are taking the total revenue from the P&L account. They are not seeing what is the component of the revenue. They are not saying exempt, taxable. They are not worried about all those things. They are saying, okay, total turnover, total revenue is 8 crores. You please pay tax on 8 crores. They're giving notice just on that basis only. So what will happen if you have a revenue recognition policy which is a little bit more detailed? From my limited experience with DH authorities, I can tell you one thing. If you give them more information, they will get confused. They'll accept what you are saying. You tell them that this is what my revenue recognition policy is. They will not ask any further details beyond that. It helps in that way also, apart from giving a little bit more disclosure on other factors. Slow and non-moving inventory. This is again something which all of us have probably read a lot about. But again here, this is AS 28 impairment is not applicable to inventory. We saw that here because inventory is not applicable because you have a separate standard for inventory. Slow and non-moving inventory is nothing but impairment testing for inventory. It is nothing but impairment testing for inventory. Many enterprises, many non-corporate enterprises, we'll say, okay, raw material, finished goods, and work in progress. Sorry, raw material, work in progress, finished goods. This is what we know. What are the components of that raw material? What are the components of finished goods? What is the aging of that? We do not know. In many cases, we may not know also because they're not required to be given. But if you look at it from the point of view of the enterprise also and the entity also, it may be useful for them to have this information because it is very obvious that slow and non-moving inventory will not be valued at what normal inventory is being valued at. This is something which all of us are aware of. I mean, as chartered accountants, we are very aware of this fact. Normal inventory will be valued at X means slow and non-moving will always be valued at X minus something. Is there an accounting policy to check for slow and non-moving inventory? More than an accounting policy, does the enterprise have a process to check for slow and non-moving inventory? You will be surprised that if you ask this question, many a time they will say it is there, but it has not been specifically identified. Because I spoke a lot about impairment, please add this also as a question when you ask for this. Do you have any slow and non-moving inventory? Because it could be possible that it is there. This is again something all of us are aware of. Contingents and events of the balance sheet date. Right from our CA entrance exam days, we know only one thing: fire in the factory. That's an example. For adjusting event, non-adjusting event, they always say fire in the factory. They want all the factories to go on fire, I think. Fire in the factory is non-adjusting event because only a disclosure requirement is there because the event did not occur on the reporting date. This is what they say. Adjusting event, you will adjust, you will pass an accounting entry. Non-adjusting event, you will only disclose it. For an entry to be made, it has to be existing on the balance sheet date, which means that transaction had probably already taken place. Only one event we were waiting for: a decision of NCLT, decision of High Court, decision of Supreme Court, decision of Income Tax Department. Many of these things which are event had already happened. We were just waiting for the formal conclusion of the event to happen. Those can be adjusting events. Adjusting events, of course, we pass an accounting entry. For non-adjusting events, it's only a disclosure. This is, I think, something we have learned right from our early days of this thing here. But what is important to understand is that they talk about from the balance sheet date or from the reporting date till the date of finalization of the financial statements, which could be 2-3 months down the line or 4 months, because nowadays all reporting periods have been compressed. Everybody's wanting to report earlier now. So now what will happen is that please look at those events, what have happened from the balance sheet date 31st March till your signing date. Look at adjusting, non-adjusting events. A very good example I can give you all is probably a trade receivable for which a small provision has been made. What is called as provision for bad and doubtful debts. Let us say that you had about 40 lakhs of rupees as trade receivable. What 5 lakhs already provision because that person has not paid you for the last 3-4 years. You made a provision of 5 or 10 lakhs of rupees. Subsequently, on the 15th of April, he declared bankruptcy, or IBBI, or under insolvency code, he declared insolvency also, IBC. You already have a provision. It was a trade receivable. It was existing on the balance sheet date. Only thing which has happened subsequently was the fact that it has been confirmed that it has become a liquidated or whatever it may be. You can probably classify this as an adjusting event and make an entry in the accounts itself for 31st March instead of waiting for subsequent year 31st March of the next year and all. So all we have to remember is that whether that event was there on the balance. That's why they said fire in the factory is only non-adjusting, because fire did not happen on 31st of March. So this is something we have to keep in mind definitely. This is a very interesting topic again, construction contracts, because as all of you all know, AS7 spoke about the POC method. AS9 was the revenue, non-construction contracts. And mother and builders who are probably non-corporate entities also. One of the interesting things in AS7 is that it says, okay, you start the POC method, you do the POC method, because it is work in progress. You are over a long period of time, you will get revenue, therefore you do the POC method. But very interestingly, what has happened, the standard does not tell you when do you commence your POC method. It says that you do POC method. When do I start that, input method, output method, when do I start it? Because of the silence of the standard on this topic, ICAI came out with a guidance note. In the document, important, but I will first explain AS7 for you. This guidance note has become legendary. What they said was that construction and development expenses more than 25% of project cost. 25% of the area, total area, has to be secured by contracts. 10% of revenue has to be received as per the agreement of sale, which means you should have an agreement of sale also. If all this is met, you can commence your POC method, which means that stage of completion, total revenue, input method, add your profit margin, get your revenue. Very interestingly, what the standard says is that if this is not met, you will recognize cost and revenue simultaneously, which means that no profit element can be added into this. So this guidance note of the institute gave a lot of clarity as to when to commence the POC method. Till this stage is reached, what all the relation enterprises should do is that total cost, total revenue, matching concept, no profit element. Total cost 10 lakhs of rupees, total revenue 10 lakhs of rupees. Finished, over, nothing, no need for any POC, input cost. This guidance note gave a lot of clarity on when do we commence the POC. Interestingly, what happened, why I told this become legendary is because the institute gave a similar guidance note for Ind AS companies also. You should just remember this. This is, I mean, not related to the directly to the topic, but still a very interesting thing here for you all to understand. Ind AS guidance note. Then this Ind AS 115 came. It said some performance obligation. They said all those things. Because Ind AS 115 came, what the ICA did was they withdrew this guidance note. They said it is not required for Ind AS companies because Ind AS 115 is there, withdraw pantangi. What many of the real estate companies did was, because this guidance note was withdrawn, they said that, no, you cannot do POC method, you have to do completed contract method only. You can see a lot of these real estate entities transition to Ind AS, they did only the CC method, completed contract method. Nobody did your POC method. The only reason was because guidance note was withdrawn, not because of Ind AS 115. So, to summarize for you all, in case you have got these three methods, please remember that the guidance note is still applicable for non-Ind AS companies. It has been withdrawn only for Ind AS companies. So, either one that if you have got a non-Ind AS company who's or NC who's in the construction business or real estate business, these three methods or these three requirements are met. That is when your POC method will actually start. Otherwise, total cost, total revenue matching. AS9, again, all of your revenue, very important. Very important topic, and all of you have done a lot of work on this. Again, linked to GST and all that is there. Complicated transactions, AS9 did not cover. Complicated transactions, AS9 did not cover. Barter transactions did not cover. So it was a very simple standard. As I told you, I just mentioned about the transfer of significant risk and reward and left it at that. But revenue recognition is a very complex topic by itself. And it's also not only entity specific, but also contract specific. It's not only entity specific, but also contract specific. So, this topic of significant risk and reward, which we have been talking about a bit about for some time now, it is something which all of us know that for a specific entity, a specific method of revenue recognition is, I won't say permanent, is what they are normally following. Again, contract driven, all this we know. US GAAP incidentally had a very interesting topic on revenue recognition. They said that if delivery is given, control is lost. If control is lost, revenue can be recognized. So each of these different accounting standards have got different methods of revenue recognition, but we'll stick to AS9, which talks about significant risk and reward. So what I'm going to do here, with the permission of Manimegla Madam, is that I'm going to put one case study in front of you all. I'll give an example to all of you all. Anybody can reply on chat. Using this thing, anybody can reply on chat. I mean, because this is also the first time, virtual learning, you have to get used to all these things, right? MCQ, you have to get used to all the MCQ stuff and all. But I'm going to give you an example. The example is not in the PowerPoint, incidentally. I'm going to explain this only to you all, and just anybody can reply on chat and say whether what the response is. So at least this will make it a little bit more interactive. This is a transaction that actually happened incidentally. This happened on March 25th, 2020. There is a company in Bangalore, which all of you are aware of, called as Bharat Electronics Limited. Bharat Electronics Limited manufactures defense equipment, electronic equipment for Ministry of Defense. Their main customer is Ministry of Defense, and they do manufacture a lot of these machines. Medical equipment is also being done by them. But their main customer is Ministry of Defense. On the 24th of March 2020, Bharat Electronics had one machine which was ready in their factory in Bangalore, ready to be shipped to the Ministry of Defense in Delhi. Total worth of the machine was 7.5 crores, out of which they had already got an advance of 3.5 crores. And it was the responsibility of the Ministry of Defense to come to Bangalore, pick up the machine and get it transported as per the contract. It was ready. They informed the Ministry of Defense. Ministry of Defense said, okay, come, we'll come and take it sometime, they said. This was March 24, 2020. March 25th, lockdown was announced, national lockdown. No chance of any movement at all, at least for some time. Ministry of Defense said that, okay, now anyhow lockdown is there, we cannot remove the machinery. So please keep it in your warehouse. We will see what happens later on. We will come and pick it up once everything is, the situation improves. So Bharat Electronics took the machine from their factory or wherever it was ready and put it into a separate warehouse. And decided that, okay, whenever these people come, they will ship the machine. As far as Bharat Electronics are concerned, they had done all their obligations. They had done everything which they had to do for that particular machine. Transportation is responsibility. The question is now for all of you all, can they recognize 7.5 crores worth of revenue in their books of account? Because according to them, you use the word called significant risk and reward. As I said, anybody can respond on chat. If you want to ask more questions on this particular transaction also, you can ask. We will see if anybody has responded or will respond. As of now, nobody has responded. If you want to have any further questions, you can ask on this also, no problem. You can ask on chat, you can come on video and ask. I'm giving that concession to all of you all. You can do anything you all want. Come and ask on video, ask further questions, anything you all can do. Okay, no question. Nobody has responded, madam. Yarume illa pola irukku. This is one problem online. Video idu pannalena yarume do not know. Neenga rendu pera dhaan paathuட்டு கேக்க போறீங்க. Anyway, so one of the things which becomes important here for you all to understand is that, okay, Bharat Electronics edutanga pottaanga. They put it in their warehouse. They made one mistake. They made a very, very major mistake they made. They took insurance for warehousing in their name. They took an insurance for that machinery for warehousing or storage or warehousing insurance in their name. Okay, one person has, Manivel has, sir has said, to be recognized. But now I think he'll change his view after what I told just now. Because they took insurance in their name, it was very clear that the risk is still there. They could have taken insurance, third-party insurance. They didn't do third-party insurance. They took insurance in their name only. So you all can see why I gave this example is because it's a very clear example of this transfer of significant risk and reward. Even a small thing like a storage insurance can possibly decide whether risk and reward has been transferred or not. There are plenty of examples I can give you all. Of course, we will look at all that later on when some other time we'll probably look at it. But right now, what members should very clearly understand is that look at the contract. Please use one word which India is very clearly used called as control. Has control been transferred? If control has not been transferred, please revisit whether revenue can be recognized or not. I can tell you all, with there are many cases we can look at wherein revenue recognition has become a problem because companies, I'm not saying they're doing it willingly, voluntarily, or with an intention to, do something wrong or something of that sort. But genuinely speaking, they feel that this revenue recognition is possible. The importance of revenue as part of the financial statements, I need not tell you, which is obviously very, very critical. For any enterprise, is very, very critical. But when we look at the policy or you look at the entity-specific policy, some practices which are being, followed by some entities, we may want to look at it from a different perspective because they may want to change the revenue recognition policy because it may not meet the requirements of AS9. That's all I'm trying to say here. The barter transaction, of course, again for NCEs, it may not be applicable, but it is possible also because barter transaction basically talks about advertising contracts wherein no money is exchanged. Advertising company is very, very common to have barter transactions. I put advertisement, you put an advertisement, no money is paid. See, a very interesting thing again, I'll tell you all, which is for this barter transaction. In 2006, it happened. This was an agreement between Air Deccan and NDTV. At the time, of course, Air Deccan was flying. NDTV is still there now. They had a very simple agreement. NDTV will show advertisement of Air Deccan on their channel for 3 months. 3 months, NDTV will on their channel at some particular allotted time, they will show Air Deccan advertisement. In turn, what Air Deccan will do, they will put NDTV logo on their aircraft for 3 months. Very simple agreement. 2 pages agreement. Nothing, no complications. No money was exchanged. They said, you put the advertisement, I'll put the logo over. No problem at all. Unfortunately, what happened at the end of about 2 months or 1.5 months, NDTV, they did not put the advertisement. Advertisement did not come for some time. So Air Deccan went and said, I'll put you to court of law, I'll put the case against you, all those things they said. Delhi High Court was hearing this case and asked, what is the value of the transaction? Because it was a barter transaction, there was no value which was there in the books. Delhi High Court specifically asked, what is the value recorded in the books of account? They said, no value in the books of account. They passed an order saying that if the transaction has not been recorded in the books of account, no compensatory damages can be awarded by a court. Please settle out of court. Why I'm giving this example to all of you all? Because again, service tax valuation rules were changed in 2006 only because of this particular case. Barter transactions being taxable under service tax came only because of NDTV case. You look at an advertising company who's NCE today, non-corporate entity. They may have transactions with other entities. Strictly following AS9, they need not recognize revenue because it's a barter transaction. But other standards may require them to, I mean, like for example, even Ind AS 18 also they may require them to follow revenue. But AS9 they kadayadu. So if it is not there, you don't have to recognize it. But again, the problems of AS9 I'm trying to add it in front of you. PP already told you. AS11, para 46 and 46, we spoke about this foreign currency translation reserve account for foreign currency borrowings for long-term monetary items. That is still there. That is basically if you're having a long-term foreign currency borrowing account and those exchange differences can go and sit in your, it can be capitalized number one initially, and differences can go and sit in your foreign FCTMR account, need not be going to your profit or loss account. Major relief for companies who are exposed to foreign currency. As all of you know, okay, today the dollar is 80 rupees, touching 80 rupees. So any company who has got this foreign exchange contract, suffering the impact of foreign exchange transactions, the foreign currency translation reserve account for long-term monetary items would help them to protect their profits, or will help them not to, throw too much of a hit on the profits there. 13, 14, not much of changes there. So we will just look at only the main part of this. Of course, I told you all for 13 and 14, amalgamations, if an amalgamation happens, you have to follow the standard. But again, we're talking about non-corporate entities. The chances of those amalgamations happening are probably, not so high, but they are very clear. If it is there, you please follow it. Investments, I already told you all, because of the lack of a standard on financial instruments, you may have some problem in accounting for certain complicated or even simple financial instruments because of the fact that AS 30, 31, 32 is not there. Another, you may have some issues in terms of trying to, get a right standard for that. But anyway, we will see if it is coming to the standard, then we'll have to follow it. That's deferred taxes. This is a very important standard. I told you about depreciation, 43 for losses. They are using the word called as virtual certainty. This is a word which has come only in AS. It is not there even in Ind AS. Ind AS uses the word called as probable. which basically what they're trying to say here is that if you have got carried forward losses, deferred tax asset of those losses can be recognized only if it is virtually certain that you will generate enough profits in the future to set off those losses. Very simple logic there. But what is virtual certainty? They don't say what is virtual certainty. The very fact that they've used the word virtual certainty in my mind means that if they have got some history of profits in the past, possibility. Otherwise, very difficult to recognize deferred tax assets. I'll give you an example of a company like Flipkart. You look at Flipkart's balance sheet. You look at Flipkart's profit and loss account or profit and loss account. The possibility of Flipkart making a profit is virtually uncertain. I won't say virtually uncertain, it's uncertain. And they're very, very limited possibility because huge carry forward losses, year on year keeping on adding. No chance of Flipkart getting profits at least the next 10 years, even if they show profits from next year. See, when I told this about 10 years back in some conference, they said, no, you know what? If Flipkart starts charging for deliveries, then they will make a profit. Yes, they have now started charging for deliveries also. Flipkart is no longer free delivery. They're charging you for deliveries also. But they're still having losses because of the discounted price of the products and the amount they have to pay to those vendors. See, today, if I get a Samsung phone on Flipkart for 8,000 rupees, there is absolutely no guarantee that the Samsung company is going to be paid 8,000 rupees. They'll probably be paid more also. We do not know. So for a company like Flipkart, trying to recognize, deferred taxes, impossible because of the use of this word called as virtual certainty. Virtual certainty has the entity reported at least 1 year or a couple of years of profit in the past. I mean, I'll use that as a basis, or have the losses being reducing consistently. Either end domain possibility. Otherwise, I don't see the word virtual certainty being used anywhere at all. Impairment already solliyachu. Provisions, contingent liabilities, and AS 29, again, a very important standard, almost the same as Ind AS, as I told you all. Few words which are very important. Current obligation from past event. If the amount is certain, it is a liability. If the amount is uncertain, it's a provision. As per the standard. Current obligation from past event, if the amount is certain, it's a liability. If the amount is uncertain, it's a provision. AS 29 has said it. All the standards have said it. So I don't understand why they call it as provision for audit fees. Because the amount is certain, it should be a liability only. If you go by the definition, I do not know why they call it as provision for audit fees. It should be a liability because you have to pay him. The amount is certain. The amount is contracted, known about it. So in this 29, there is one clause which is called as onerous contract. A similar thing to what is there in AS 11 for construction contracts. In construction contracts, there is one clause which says that at the initial stage of the contract, if the losses or the revenues are going to be lesser than the total amount of costs incurred, you please account for those losses immediately. The same thing can be used as an onerous contract in AS 29. In any contract, suppose the costs or the costs exceed the revenues we are going to be getting, it meets the definition of an onerous contract. The difference of the losses will have to be recognized immediately. It's easier said than done. Because you take, for example, an infra project. The infra company will probably be feeling that, okay, I can ask for an escalation. I can ask for an increase in prices. Right now, I may have a loss. Next year, it may become a profit because he'll have all these thoughts in his mind. If I strictly follow AS 29 and at the contract initiation stage, if there is a loss, it has to be recognized. Now the contract is amended next year and it's possibility of a profit, you can reverse the loss. That is permitted by AS 29 also. But this word called as onerous contract becomes very important to understand, because again, we will see many situations wherein companies have got into contracts, entered into contracts knowing they are under a loss. Those sort of contracts would have to be provided for completely. Most reliable estimate will have to be made. So this is as far as the accounting standards are concerned. Now, this document, I would suggest to all of you all to definitely download it and please go through it, because ICAI has been proactive in trying to give out standard formats, shall I say, for financial reporting for many of these non-corporate entities. Because as we all know, and we have to admit, different accounting presentations are possible. Because I'm not bound by the Companies Act. I'm not bound by SEBI LODR regulations. I'm not bound by RBI. I'm not bound by IRDA. I don't have any regulator falling behind my back for a non-corporate entity. I can present in any manner I want. The limited purpose of an NC non-corporate entity's financial statements are probably for filing the income tax return. Number one. Second, maybe also to give it to the banker. The banker is only interested in a few numbers, profit, the assets are there or not, he's only interested. So it does not matter what format we're trying to give it. I'm not saying we have not followed a consistent format, but what the ICAI has done now is that they have tried to align this with the provisions of the Companies Act Schedule 3, with a change in the wordings also. Why is this required? Because they want to bring, or to the extent possible, they want to ensure that there is consistency in financial reporting across all the non-corporate entities. This is what has been said here. Consistency and comparability in the presentation, disclosure of financial information would be of immense use to this thing here, right? So they have given, just like Companies Act Schedule 3, they have given general instructions. The format has been given here. And please remember that the disclosure requirements given here are not replacement for what is given in the accounting standard. What is given there, you still have to give. But these requirements are a little bit in addition to what has been given by the accounting standard. So just because you have a disclosure requirement here, we cannot take an exemption. It is not there in the accounting standards. Again, here, if you look at what the ICAI has been saying, I told you they're just taken a few portions in the Companies Act. They are saying that the balance sheet is an aggregation of items in the financial statements. Notes and accounts are a disaggregation. If an enterprise wants to report certain transactions in the notes and accounts as a disaggregation, they are free to do so. Because please remember that once your PPE schedule has, not even PPE schedule, once your cash flow statement has been finalized, after your cash flow, everything is left to us only. Those notes are all completely in our control only. What we write, how we present, how we do it. There's no format in Companies Act for that, apart from the disclosure requirements which has been given there. So what they are trying to say here is that in case you have got some information which you feel is very, very important, adding to that main, or what you can possibly call as the aggregation of information. Okay. That portion, something happened. Okay. That portion, if you want to disaggregate and give it more, you can give more information. This is only from the point of view of financial reporting and disclosure, nothing else. It is there in your Companies Act Schedule 2 also, Schedule 3 also. Rounding off. This is very important from the point of view of chartered accountants, because many people have asked me this question. Why should the Companies Act be worried about rounding off? Non-corporate entity, they want to give full figures in it. They want to give in the lakhs crores. They are saying euro businesses. So why do I have to give it in rounding off to this year? Rounding off means, please remember, rounding off means what? Not rounding off to the nearest rupee and the money. They are talking about rounding off means presentation of financial statements in this amounts, in this quantum. 100 crores or lesser than 100 crores, in the hundreds, thousands, lakhs or millions are there. Hundreds, thousands, lakhs, millions or decimals thereof. Crores kadiyadu. More than 100 crores you can do in crores. I do not know honestly why this requirement is there, because let us say, for example, a non-corporate entity in Madurai only. NC in Madurai with 95 crores worth of turnover, 95 crores turnover. They've got 100 crores worth of assets. Why are they being prevented from showing in crores? The banker may want it in crores. The banker may want to see these statements in crores. But if you look at this here, they will not be able to present it in crores because they have to give only the hundreds, thousands, lakhs or millions. See, at least for many of us chartered accountants, millions is something which we are not very familiar with. I'm not saying we should, we don't do it in millions alone, but we have used only lakhs or crores. So they have got this problem here because if I've got this NC with 95 crores out of 150 crores worth of assets, they are prevented from showing it in crores because of this guidance note. Of course, I can tell you all that because it's a guidance note, you all can ignore it and say, I'm still going to present it in crores. But schedule 2, there you don't have a problem there because you're mandatory, you have to follow it in schedule 2 there. So I think this will have to be probably changed and they should give the freedom to show in any format you want as long as you are consistent. I don't think they should force entities to show, because as all of you will probably be aware, many entities will want to show full figures. In the thousands, they want to show full figures. If I look at this, I have to do minimum of thousands or hundreds. I cannot show full figures also. So according to me, this requirement is not required at all. Okay, companies that is a different issue altogether. For non-corporate entity, why do you want to put this restriction or this, mandate here? According to me, this should not be there. But as I said, because this is only a suggestion from the institute, that non-corporate entity in Madurai with 95 crores turnover, 150 crores worth of assets, I would still say please present in crores because your banker is comfortable with crores. The banker may be comfortable with crores, so give it to him in crores only. This because this is not mandatory. They're not going to violate any law by doing this. I'll take you all through a few of these important items here. You can see that format vandittu just like your schedule 3 only. They've changed the names. Owners fund, equity share capital kadiyadu because it's a non-corporate entity. They've changed it to equity owners fund. Owners fund has got 2 components, owners capital account and reserves and surplus. All the rest are continuing as per your normal schedule 3. I've taken only a few hints, a few important things. MSME disclosure, no exemption has been given. This is something which, again, maybe it's important from the point of view of the MSME Act, but the total outstanding dues will have to be presented separately here. Of course, the interest clause as per the MSME Act is still there. That clause is still there. But for a non-corporate entity, because you're a non-corporate entity, there is no specific exemption. That's what I'm trying to say. Balance sheet wording, it's all changed now. It has become property, plant and equipment, intangible assets, CWIP. Changes in the Companies Act because of the Schedule 3 also, intangible assets under development. The reason for the intangible assets under development is because of this, a lot of startup companies coming up here and they are having a lot of intangible assets. A lot of startups are having intangible assets. So that is why it's there both in the Companies Act as well as in this set of suggested formats for non-corporate entities given by the ICA. But here, I think one thing which I should probably mention to all the members and which is important also is that you take, for example, an item like other non-current assets. Non-current assets had more than 1 year, that we all know. Long-term loans and advances separately classified there. You will find, especially in the trial balance of a non-corporate entity, you will find a few items which will probably fit under, say, for example, other non-current assets. A deposit, I told you, for example, security deposit. I don't see any security deposit coming separately here. So a security deposit for a lease asset will probably come under other non-current assets. The standard or the, for example, there's no standard non-current asset, for example, but all we have to think about is maintaining consistency. So I don't have to change between these classifications here. Please remember that because this is the first time we are going to transition to this, whatever classification you are doing here would probably hold you in good stead in the future also, because you are probably going to follow this for the future also. So within this, items, there could be a small, not concern, small classification which you may probably have to look at and see what falls into where this thing. So of course, as all of you are aware, what you'll probably do is that on the trial balance here, you'll say under what category it is coming here. I'll come to that when I do the other part of it, right? There's no change. Sundry debtors has now become trade receivables. The word has changed to trade receivables. Sundry debtors use பண்ணாதீங்க இப்பெல்லாம். இப்பெல்லாம் நீங்க ரொம்ப fashionable இருக்கணும்னா, you don't use fixed assets, use PPE. Don't use sundry debtors. Use the word called as trade receivable and trade payable, because that is the latest thing which is going on there now. Results and surplus, they are given a separate classification. And this is the main statement, your profit or loss account. No change from what we know. Revenue from operations, other income is there. They're not saying other operating income, other non-operating income. And the word use pannalavanga. They're just saying revenue from operations, other income. Cost of goods sold, they've got all these depreciation and other expenses there. Profit or loss before exceptional items. Exceptional items have been specifically given there, and profit or loss before exceptional extraordinary items also has been mentioned there. This extraordinary versus exceptional is only there in AS. It is not there in Ind AS, but only for AS it is there. Randomly separate classify pannu. Exceptional item means what? Normal course of business, very high value item. Raj, write-off of a trade receivable, exceptional item. Extraordinary item means what? Not in the normal course of business, but very significant because of the impact. Sale of one entity at a loss, or sale of one business unit at a loss. Extraordinary item, because you're not going to do it every day. Once in a time. So that classification or the distinction between exceptional and extraordinary is there only in AS, not there in Ind AS. Again, let me tell you all, because you are going to give this, look at what has happened here. Revenue from operations is 19, other income is 20. Note number, note number, you can have a different note number in your set of financial statements. Why is it important for us to look at this? Because if I go back to 19 and 20, look at the note number. This is what will help you in your GST reconciliation. That is where you will say this is non-taxable item, this is taxable item. So what you give a note 19 and 20 becomes more important than what you give on the face of the profit or loss account. You have to give full details of what is your total income, what is the revenue from operations, what is the other non-operating income. There you can give it in any format you want, because nobody is preserving any format for you there. Again, as I told you, MSME, no exemption, unfortunately, even for non-corporate entities. See, I just want to have a general word about this MSME thing also. It is generally felt that but you look at what the MSME Act says. The MSME Act actually says that in case you do not pay that person within 45 days from the due date of payment, you will have to pay him interest at 3 times the RBI reference rate, or the bank rate has been suggested by the RBI. If by 80%, you have to pay him at 24% interest. This is what the MSME Act says. There are 2 things which are important here. One is the disclosure of total unpaid item. Second is providing for the interest. Probably a question which all of you will ask me is, should I also pay the interest? See, if the MSME knows about it, he's going to definitely ask you for the interest. Why will he stay quiet if you know that you have provided for it in India? But you're going to give only one bulk figure here. You're going to say that, okay, total amount outstanding this much, total interest provided is, you're going to disclose the interest portion. Even though it may not be mandatory for you to pay the interest, because that's a transaction between you and the MSME. But strictly going by the MSME Act, if you look at what section 16 says there, you will have to not only provide for it, the moment you provide for it, it becomes an obligation for you. You will also have to probably pay it. This is what section 16 says. This is not of this act, but of the MSME Act, right? 3 times the bank rate notified by the Reserve Bank of India. So bank rate notified by the Reserve Bank of India, you will have to see this here. You see what they have given in this guidance note also. They have said that amount of interest accrued and remaining unpaid at the end of each accounting year and further interest given there. So many people will have this question. They'll have this doubt also. And I think all of you who have probably done a few financial statements also agree with what has happened here. The responsibility of saying whether you are an MSME or not is depending on is on the MSME, not on my entity. I can ask him. I can ask the my suppliers, are you MSME or not? If they do not reply, I cannot assume that they are an MSME. So the obligation is not upon me. Responsibility for saying MSME or not is on the MSME itself, not upon individual or the entity as such. So I will go and tell them that, okay, please give me, all of you who are my suppliers, please tell me if you are MSME or not. Because I have to do a provision in my books of account, I have more than a provision, I have to probably classify and pay you within 45 days. The responsibility lies on the MSME, not on us. So I think that much is very, very clear. But if I do get feedback from the MSMEs in the days time and MSME, and he gives me a certificate also, then I will have to do this exercise. The entity will have to do this exercise of not only providing for the the trade paper and ensuring it's paid within 45 days, but also ensuring that interest has been also provided for. And of course, the interest has been provided for now. Okay, if you, in case he demands for it, you have to pay for it. But there are a lot of challenges here. Say, for example, you go and tell the MSME, boss, 45 days, I'm not going to pay you. I'll pay you in 60 days. I'm having some financial trouble. He agrees for it. Then what happens in that particular case? He says, okay, fine. I also understand what the situation you're going through. Parallel, pay me in 60 days time, not an issue at all. Legally, I will still have an obligation to pay him 45 days, but because it's a contractual obligation, I may probably come in only on the 60th day, not on the 45th day. So all of these issues will have to be thought about when we are doing this reporting for the financial enterprise here. What I have done here is I have given you only extracts. I have given you only extracts of what is there in this document given by the ICA. So if you are asking me a question whether it is mandated to follow it, it is not. It is not. It is only recommended for you to follow it. But as I will be telling you in my last slide today, encourage NCEs to follow the format. We are going towards an era of more disclosures, better disclosures. We are going towards an era of transparency. Focus on financial reporting, not only on accounting. See, the accounting is something which everybody will do. There's no discussion about it. Accounting. But we seem to be moving towards an era wherein financial reporting becomes very important. And of course, you are going to follow all the ASs. You are going to take some exemption given by these particular ASs, only the disclosure exemption incidentally. But yes, you will have to focus on the financial reporting because of the fact that in case there is any sort of information requirement or data requirement by anybody, it can be department, it can be SEBI, it can be anybody. The more information you give, the better it is. When we speak about financial reporting, we are speaking from two places here. One is what the entity does. So they will have their own set of, for example, procedures, processes, and all those things. Adanada, what I put in the last slide is that please integrate this with Tally Prime. Tally Prime now portal, you can do Zoho books and you can do that. Because once the format has been pushed into Tally Prime, reporting becomes very easy. If you go back and put the same formats here in your main items of Tally Prime, for example, reporting, for example, you don't say share capital, you put owner's fund. Reporting becomes much easier. Yeah. Even here, you have one item for revenue from operations, sub-classification, you can do what now the revenue from operations, sale of good, rendering of, you can put it a sub-classification from revenue from operations. So why I am saying Tally Prime is because, of course, many of you are probably familiar with Tally, but whatever package you're using, doesn't really matter what it is. I will give you all one example before I end today's session. And I mean, we can always take questions also, not a problem. Why this financial reporting is becoming very, very important and not only pure play accounting. There is a small, of course, this was not a company also, this was a LLP actually, small LLP who was doing a lot of work for Amazon, the platform. They're doing a lot of selling for Amazon platform and all those things. And there was some dispute which came up between Amazon and this particular LLP. It turned out to be a very major dispute because it went into the High Court of Karnataka, then Amazon put a case to the US. It became very complicated disclosure. I mean, it became a very complicated case because basically what the basic fundamental part of the case was that Amazon was trying to say that you are not selling the products which you promised to sell, which means that there was a problem in your quality and all those things. And the enterprise was saying that, look, you saw my product when you took it on your platform. Discussion. But anyway, this went to the Karnataka High Court. In the Karnataka High Court, when this hearing was happening, they asked this company, LLP, what is your basic argument? And what is the reason you're having this argument? In that case, I mean, they had also submitted various documents to the court. One document was the financial statements of the enterprise. And the financial statement, they had given one complete full page on this dispute with Amazon. What they had written was that Amazon is charging me with saying that, no, your product is not of proper quality. What we are giving to everybody else, we are giving to Amazon also. So there, this thing is not valid on all those things. Nadia, our full description of Kurtam. Karnataka High Court, in all their, the course of the judgment, also said that it is very rare to see an LLP's financial statements have been actually given so much of detail about this particular transaction. And I think personally that disclosure helped them to get a judgment in their favor from the Karnataka High Court. Because they were very clear in their description, what was the dispute, what was the nature of the dispute, what had happened there. So that's why I'm saying that for all of you all who are got, I mean, the format is already given by the ICA for all of you all. It is there in front of all of you all. My, suggestion to all of you all would be that, my recommendation to all of you all would be that, in case your client is a non-corporate entity, please look at this format, send it to him. The moment you send it to him, sir, he's going to give it back to you only. But please send it to him and tell him that at least put this, or tell the accountant to put this as a part of the financial statements. Startingly, that will be a very good first step to take. Later on, of course, as they start preparing the financial statements, they can do all those things of further disclosures. Definitely they can do this here. See, anybody who is requiring data from these financial statements should be able to pick up the data based on two things. One is, what is your accounting policy? Second, what is the amount of disclosures you're doing? Please remember that what has been given here is only a format. Format katayaning panida, that's a different issue, because it's already there for you. You might as well do it and give it, right? But what you have to definitely keep in mind is that it's very important to understand that the more the information you give, the better it is for not only the regulators understanding and whoever the outsiders. They use this word called as user of financial statements. It can be anybody. investor, for example, he may be looking at certain information. Useful. So encourage your clients to do this, not only format, but also be a little bit more better in their financial reporting. Give a little more detail than is required. And I am not saying that you should do it for 31st March 2023 immediately or 22 hours. It's a process. Make a start now. As you move along, you all can probably make further improvements and see how it goes, right? So with that, I think I've come to the end of my presentation. I have already shared the presentation with the branch. So members who are interested can look at this presentation also. In case there are any questions, I'll be happy to take them. Thank you very much, madam. Thank you.
Thank you, sir. It was a very wonderful session. Members, any doubt, any clarification required, please come forward to ask your questions. Ravi, sir.
Yeah, I'm here. Tell me.
Any doubts, sir?
Oh. It was really a wonderful session, sir.
Are there doubt on
Like, before putting it down, okay? Like, you have any idea or information, though it is not mandatory and it is only recommendatory, how many non-corporate entities are providing statements in this format? Have any information? Have any clue on that?
As of today, 0, sir.
0. Okay.
As of today, 0.
Great.
This has come only last month now, so it will take some time.
No, but it is there, no? Even earlier also, it was only recommendatory, no?
It was only there, but now they have given this revised format as per the schedule. I mean, going as per schedule 3, but hardly anybody.
But really, a lot of information need to be culled out for such non-corporate entities to give it in this format. It will be really a tough job for us because such non-corporate entities will not have the infrastructure. Only we will have to cull out all this information.
Non-corporate entity, non-cooperation.
Corporate entities, right?
And also, of course, one thing which I have not spoken about is that if the auditor, as in most of the cases, will be doing it. In most of the cases, we'll be doing this information, right?
Yes.
I think compensation fees are
Yeah, naturally, because the question of affordability will be there. No,
always be there. So in that case, if there's no reward, there's no remuneration, there's no benefit also.
We'll not be also inclined to work on that now.
Absolutely, obviously, sir, obviously.
And regarding this MSME, you were trying to tell us, no, like the responsibility is casted only on the sector and not on the enterprises, not on the entities.
Yeah.
I don't think so, sir, because the entity have to check up, okay, have to check up, and they will have to find out it. The responsibility is equally on the non-corporate entities also. So the same provision is applicable for corporate also. The corporates follow up with the suppliers, okay, with their suppliers or with the purchaser, and they find out whether they are MSME, and they are bound to include state accordingly. Whether if they say MSME sector, they are bound to include it accordingly. So
No. I think so. Let me clarify here. My primary obligation is to find out whether MSME or not. Right. But I am talking about a situation wherein, suppose the fellow has not responded. I cannot assume he's an MSME. I should assume he's not an MSME because he's not. That's what I'm trying to say.
Like what they are insisting, before getting into transaction with a particular sector, you have to make sure whether it is MSME, and then you enter into transaction.
Okay. Yeah. I mean, of course, that we'll have to see. That we'll see. I think most of the people will know whether you are talking about a few rare cases where there's no response here. But I would still feel it is both ways. If he does not respond, I do not have to go beyond a particular measure to find out whether he really is an MSME or not.
And there is one more query from our chat account in Natmiko sir. It is there in the chat box. If you just click it, you will be able to see it. He is asking us whether we need to prepare it in 2 formats, one for this and one for the ITR, because we need to sometimes enclose it along with the Form 3CB, 3CD and all that, no?
Yeah. If you are following this format, obviously ITR separate. It will be separate only. But
We can't attach this new format. Can't we attach this new format in the ITR, sir?
you can see. Anyway, ultimately, you see, now what has happened today is that your tax audit report and ITR have become separate exercises by themselves. There's no limit in tax audit report and ITR preparation. Rendume separate exercise because of the fact that this thing here. But what I can suggest you all can do is that you all can tune this format to meet the tax audit requirements.
To fulfill the tax audit
Yeah,
purpose.
you can tune this format accordingly because this is only what the entity has to follow. Yeah. So you can tune this to meet the tax audit requirements. That you can do.
Normally, Manian sir used to attend all virtual program. Unfortunately, he is missing today.
Oh, I see. Okay.
Normally, we could see him in all virtual meetings. I don't know how come he is.
Maybe because I am speaking, he has not come, I think.
I don't know. Like.
Okay. Nadana Gopal sir is asking even regarding rounding off also.
Rounding off also, correct. I mean, it's applicable to that also, sir. Because see here again, you look at what an entity is normally doing, right, for tax audit purposes. They will probably present full figures only. Okay, maybe lakhs also. It depends on what has been your custom, what has been your practice here. The good thing is there's no mandate on this. So I think whatever has been your historical practice, please follow it.
Okay. So any other doubts from members? Okay, having attended the session, now we all have one challenge in front of us. We are supposed to upload our CPE in the digital learning hub. So hope all of you will try on that. And for any issues, just give us a day to, we also will have to try and upload, and hopefully we'll be able to advise you on if you have any difficulties on that. So thank you very much, sir. It was a wonderful session.
Thank you.
And I request CA Venkatesh, Secretary of the branch, to submit his vote of thanks.
Pleasant evening to one and all. It's my privilege to offer vote of thanks on this occasion. On behalf of MBSCRC of ICA, I extend a really sincere thanks to our speaker, CA Mohan sir, who spared his valuable time to address our member on accounting standards and financial statements for non-corporate entities in spite of hectic schedule. Very elaborate explanation on various accounting standards, sir. Your session is wonderful. Thank you, CA Mohan sir.
Thank you, sir. Thank you.
It gives us immense pleasure to thank all the past chairman, fellow members, women members, and the junior members for being here and for their effective and lively interaction on the above subject. Thank you. I also thank all Madurai branch managing committee members. Again, I thank you for being with us this evening. It's great pleasure. Sir, thank you, sir.
Thank you very much.
Bye, sir.
Thank you, sir. It was a very wonderful session, and your presentation was very good, sir.
Thank
Yes,
you.
sir.
Thank you. Thank you.
Thank you, sir.
Venkatesh, அப்படியே இந்த டிஜிட்டல் ஹப்புக்கு அந்த ஃபார்மாலிட்டிஸ் என்னன்னு சொல்லிட்டு போட்டு விட்டுருங்களேன்.
பாத்துருவோம் சார்.
Check பண்ணி பார்த்துட்டு we'll give you the details, sir.